Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Senior Technical Analyst with Market Rebellion, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. As you can see right here, we hit my target from last week, which was up there at 339.41. We went a little bit higher than that target. We are still under this very impressive resistance area up here, which is more or less highlighted by my green dotted line right there. And if you take out your trading checklist, and I hope you all do this, you are basically analyzing the buy signals versus the sell signals. Now we have a green candle, but look at the volume down below. The drop in volume on the way up is bearish. We have a fairly wide divergence from that moving average, which is known as the rubber band effect. That is bearish. We have the CCI down below right there. That is overbought. That is bearish. And lo and behold, you see right here the CCI, it's in overbought territory, but it is pivoting lower. So that is bearish. There's nothing on that chart that shows a buy signal. Therefore, what I'm going to do is draw my zip lines down to the lower levels here, starting with that green candle right there. So next week, remember, we have a shortened trading week. I do believe that the diamonds are going to pull back to 335.73. So that's my target for you option traders and equity traders, downside target on the diamonds. Now, if I look at QQQ, which is basically the ETF that tracks the NASDAQ market, we have a stretch of green here. That's known as a stale green light. We have 4 green candles in a row. Here's another one where we hit my target at 273.39. Not only did we hit my target, but look above here, we are reaching that gap fill resistance. So this is a resistance area that I do believe is going to hold for next week. Again, we have a drop in volume on the way up. That's bearish, wide divergence from the moving average. That is a bearish signal there. And the stochastics and CCI are both overbought, with the CCI again hinging lower. So what's the target look like for next week? It could be very similar to what I said in the diamonds. I think we're going to pull back closer to that moving average with my downside target for the Qs of 273.67. Just a quick shout out to all of our option traders. We are sitting on our hands right now, waiting for expiration Friday to come upon us next Friday, where we will once again roll for the cash. I love expiration week. We take in cash when we roll those short positions out. Okay, so looking at IWM, again, we hit the target, blew through that resistance, and guess what? Wound up right at another resistance area. Now, this is another one where if you're taking out your trading checklist, you'll see that we have a drop in volume on the way up, bearish oscillator here. The stochastics is already starting to hinge at a fairly high level. Look down here at August. The August highs were hovering at this high level. We've surpassed that overbought condition on stochastics, with the CCI starting to hinge down as well. So I'm going to erase all my lines now that those targets have been hit. I will draw this up here as a highlight for that resistance point, and I'm going to draw the downtrend here, or the zip line as I call it, to 181.11. That is IWM. Now looking at the spiders, ticker symbol SPY, same story. Big difference here is that the gap on the spiders filled yesterday, and we have that green candle on lower volume again. I think we're going to pull right back. We could go a little bit further with regard to the closeness to that moving average. I think the spiders are going to pull back in that 4-day trading week next week to 387.93. And with that, let's take a look at the VIX, because something very interesting is happening with the VIX. I've never seen this, by the way, where we had a bullish harami followed by a bearish engulfing, followed by a bullish harami, bearish engulfing, bullish harami, bearish engulfing. I mentioned this to some of our members last night on a webinar, where I've never seen that happen. Now, look down below. Look at the stochastics pivoting up. Look at the CCI at record low right here. record oversold. We're down below the minus 200 level down there. You see that? Doesn't get much more oversold than that. And so I do believe that the VIX is going to start to rip higher. I'm going to get a little bit more aggressive with that. Up to that moving average, I think the VIX could go from $18.35 up to $20.91. For you folks out there that trade the VIX on the long side, that might be good news for you. But for our option traders, that's good news as the VIX goes up, because it means that we get to take more credits in when we roll those positions. Now let's take a look at some of the geopolitical news out there. Leading the way is home sellers are basically throwing money at buyers. They're trying to incent those buyers to buy homes. They're throwing all kinds of concessions out at them. Now, that I take it as a leading indicator. When the home sale market is really dropping, it tells us that buyers know that prices are dropping. They're sitting on their hands. They're lowballing offers. And you have folks like my son and his fiance are out there shopping, and they're not in a big hurry right now. Interest rates are kind of holding for them, not really getting away to where the cost of buying a home is going to be crazy. So the buyers are sitting back, and I take that again as a leading indicator. If you look again for another leading indicator, we still have layoffs coming through. DirecTV announced this on January 11th, where hundreds of employees are going to be laid off there. Again, another economic bit of information that you can take to heart. And when it comes to the banks, check this one out. It came out recently. Swiss Central Bank posts $143 billion in losses. $143 billion. That will have a ripple effect. Absolutely. So keep an eye on the world banks and how this loss could trickle into other areas of the banking industry. Now, from a military standpoint, you have to look at this. We might have something happen over the weekend. That's why I think on the close today, we saw some short covering. I think people are flattening up on the positions prior to a 3-day weekend because anything could happen either way. And so people are flattening up and moving to cash. But you have to also look at what Russia's doing. I keep an eye on tracking the U.S. military deployments and such. But look what happened here as Russia moves Navy ships and submarines into the Black Sea with great force. In addition to that, just about a half hour ago, one of the Russian generals announced that they are at war with NATO. Now, this is not Russia declaring war on NATO. Don't misunderstand me here. But that was a release that came out that one of the Russian generals are basically stating that they're at war at NATO. And so this is escalating more than we might all want to see happen. So keep an eye on that. The last thing we want is a World War III. I don't think investors are going to like that one too much. And so that is what we have for wrapping up this week. Make sure you stay tuned at the very end, where I'm going to make some announcements here about the event in San Diego. I'll be going out there next month live. If you have any interest in subscribing to any of my trade alert services, just contact Market Rebellion. They'll do you a great job with putting together a package or a bundle, and they do not oversell or hard sell anyone. I give you my word on that. They meet the needs of those who come to us for help and education. So with that, you have a great long weekend, and we'll talk to you next time. So long.
Get your calendars out. February 17th, February 18th, live trading, San Diego. We got the Lowe's Coronado. I mean, what else would you want? This event is limited to 50 people. Look at your calendar, clear it, make sure you show up. If you want to be a rebel, this is the place to be. You got to sign up for it now. Giddy up, baby.